I'm looking at the markets and I see the sort of short squeeze, which is turning silver into a Giffen good. Now, what that means is that instead of the normal relationship where the price rises to the point where supply is generated to meet the demand, or demand drops off to the supply and there's a price balance. Instead of that, what happens with a Giffen good is that supply just disappears because nobody wants to sell because they can't buy it back. And this is the whole point. This is what's going on. Now, I don't know how far this could drive it. I mean, we saw a spike in the nickel price a couple of years back, I think it was now. This again was a big Chinese nickel magnate. He had the stock, but it wasn't in deliverable form. And the LBMA went out and cancelled a lot of the contracts, which created a lot of kerfuffle. I think that we could have the same sort of volatility in silver. I mean, silver could shoot up quite easily. Silver was going to explode. And what is China doing? I mean, it's interesting watching what's going on in the Shanghai markets, both the gold exchange and the futures exchange. Are the authorities supplying silver into the vaults? No, they're not. They're just standing back. They're letting the market sort it out, which is fascinating because in the past, they have suppressed the price of silver. They have kept control over the price of silver until it finally sort of went through the window in the second half of last year. So this is, I think, is a very, very important development. I mean, in the case of silver, there's been a supply deficit compared with demand, supply from the mines and also scrap compared with demand for the last 6 years or so. And something eventually had to give, and that's now what's happening. I mean, again, we come back to China. China is the second largest miner. It even imports silver doré from Mexico to refine. And where does the silver go? It doesn't go back to Mexico. So there's that. And also they import other ores, silver-bearing ores, copper ore, lead, zinc, whatever. Something like 60% of silver, mined silver, actually comes as a byproduct of other metals. So, and they're importing this ore and refining it and keeping it. They are the largest processor and miner of silver in the world. I'm talking about a critical mineral. But the interesting thing is that you had this guy, was it Bain Shiling?
Yeah, the billionaire.
Yeah, with over 30,000 contracts short. He accumulated this short position, as I understand it, through January, probably starting slightly earlier. And he's now been stopped from dealing. Effectively, I mean, he can close his shorts, but he can't buy any more. So there's a huge, great bear squeeze in the offing there. And I see also that the Shanghai Futures Exchange issued a notice today, having identified, I think, something like 150 malpractices, spoofing and acting in concert and, all the sort of various ways in which you can rig a market. And they're acting on it. And I sort of think to myself, well, this is actually interesting because we know that the pricing of silver is now really moving to Shanghai, hence the premium there, over the paper markets, which are desperately trying to keep the prices down. And Mike Oliver, who's a technical analyst I certainly respect, thinks that it could go to $300 by the middle of this year. I don't think I'm misquoting him.
China just ordered its banks to dump U.S. treasuries. This isn't a warning, it's the dollar's death sentence. Alasdair Macleod says the U.S. is trapped. Yields will hit 10%, then 20%. Meanwhile, China has been secretly stockpiling gold and silver for decades. They control the supply. They're letting silver rise because it destroys Western manufacturing, not theirs. Physical silver is vanishing. Paper claims are 100 to 1. The dollar is going to zero. This is the end of fiat.
I think the first thing that we will see is we will see the yields out along the long end of the yield curve rising significantly above that 5% level. I wouldn't be surprised to see yields over 10% and in the fullness of time over 20% or whatever. I mean, because there is no doubt that the US Treasury is in a debt trap. I mean, the debt trap is being sprung partly by the reluctance, I think, of foreigners to continue to subsidize Treasury deficits. It's interesting because the Chinese, when it comes to sidelining the dollar, if I put it that way, basically, until now, have taken really almost no action. I mean, it changed actually when Trump came in and he had his April the 2nd Liberation Day. Do you remember, with all the tariffs on the boards and all that? That was really, I think, what changed China's approach to the dollar. Because until then, you know, it was the Sun Tzu approach of, you know, when the enemy is making the mistakes, don't interrupt him. And that was the overall approach, I think. But I mean, Trump with his tariffs was really very, very aggressive. And that meant that China had to take a number of steps. This instruction to institutions, who I understand hold roughly half the 680 odd billion dollars of US Treasury debt, the instruction to them to reduce their holdings, I think, is a very, very important point. I think it's something we should take very, very seriously. It does mean that it won't be just China. I think there will be other nations that will be divesting themselves of US Treasury debt. You know, I don't fully understand his method, but you know, from what I've seen of his forecasts, I wouldn't go against what he said. I think he gets it more right than wrong, that's for sure. He's a very good technical analyst.
Yeah.
At the moment, I'm just watching this shortage situation and trying to follow the geopolitics behind it. And I think this is actually terribly important, Gary, because I can't find anyone really who's seriously pushing the idea that inflation is going to be a problem in 2026. The second half of this year, you will see inflation going through the roof, driven by commodity prices, driven by the producer price index, if you like, filtering through into consumer prices. This is a disaster for the dollar. The dollar is going down to zero, and what that basically means is that prices, not just gold, but prices of everything with a zero value in the dollar goes to infinity. That's the course we're on. Yeah. What's been driving this market is credit. I mean, if you look at the expansion of if you like, the leverage on, you know, FINRA reports, you know, sort of, if you like, margin debt, and that's now over 1.2 trillion. At the time of the great financial crisis, it was around about 200 billion. So you can see that this is a credit bubble. The value of these fiat currencies is going down. They are coming to the end of life because they have now reached the point of debt saturation. I mean, the whole point about a fiat currency is it allows the government to spend without having to tax. It taxes as much as it can, obviously, but there comes a point where taxpayers will rebel, or else they will refuse to continue to pay taxes and rearrange their lives so that they don't have to pay so much tax. And this is always a constraint on government. And this is why governments hate a gold standard. I mean, really, from the Great Depression, from then, they have actually managed to basically devalue, if you like, the gold standard by devaluing the dollar. And at the same time, they have tried to edge their way away from having to tie the value of fiat currencies to real money in everyone's common law. And that is final settlement with no counterparty involved in terms of obligations, and that's physical metal. Everything else is credit. And this is why John Pierpont Morgan, back in 1912, in Evidence of Congress, said gold is money and all else is credit. And he was stating a legal fact. And it is still the situation today. I mean, it's not for nothing that British pound notes or £10 notes, we don't have pound notes anymore, £10 notes have written on them a pledge saying, I promise to pay the bearer of this £10 note £10, signed by the chief cashier. What's £10? It's 10 sovereigns. Now, when I tell you that a sovereign today, I mean, I was in the market buying a few today, you pay over £900 each. In theory, I should be able to take my £10 note and get £9,000 for it in today's collapsed currency. The same situation actually is the case with the dollar. I mean, you had, so, I mean, basically, we know from history that every fiat currency eventually fails, and it fails for the same reason that they're failing today. And also, Gary, if you look at probably the best recorded currency collapse in history, which was the German Reichsmark in the wake of the First World War, you can see the interplay between the politics and the economics and all the rest of it, and you can see exactly the same thing happening today. I mean, the idea that the Germans were stupid to do what they did, look, it was politics. What's happening today? You've got a spendthrift president in President Trump. What we need is a political class who's got the guts to face up to it and go against the wishes of the electorate to actually deal with it, like cutting spending, no more welfare, no more this, complete reset.
Well, we saw, but I mean, Doge. No, I mean, if Elon Musk can't do it, nobody could do it in today's environment.
Yeah, I mean, Elon Musk, I mean, it was absolutely certain that he was going to be forced out of Doge.
But I mean, this is a guy who can reuse rockets. This is a guy who could accomplish literally anything.
Brilliant.
He's brilliant. And so I think what we saw here was the execution of the idea that, look, we're going to put Elon Musk up there. It's impossible. And we're going to show that this is an impossible task by proving that even Elon Musk can't do this. And I think we saw that now. I think the whole world knows there's no way that you can go the austerity route.
Yeah, I don't think it was a deliberate policy to show that it just can't be done. I think it's really quite simple. I mean, there's a whole divide between business and government. Musk is a businessman. He's an entrepreneur, like someone like we haven't ever seen before, or not in our generation anyway. Politics is different. That's not politics. And this is why America was so successful before the First World War, because the presidents understood that it was not the business of government to interfere in the economy. So they let the economy go. And so, I mean, apart from the big inflation, but I mean, from, I think it was 1856, you had a de facto gold standard at 20.67 to the dollar, which was, if you like, confirmed in the Gold Act of 1900. And under those circumstances, America flourished, and it flourished basically because they didn't mess around with the money, as it were. And not only that, government didn't interfere with business. Business got on with business. The two worlds are completely separate. And if you try and join them together, it's disastrous. And, and Musk, I think, God bless him, finds that out the hard way. But I mean, very sensibly, he backed out. He said, this is just ridiculous. Yeah. And he backed out. Lesson learned.
Yeah. So it's impossible.
About a good, if I may just say, another thing about a good entrepreneur, he understands when a business project isn't going to fly, he cuts it. And that's exactly what Elon Musk did.
Yeah.
Credit is the other side of debt. For every debt, there is a credit. And this has been increasingly applied to the stock market. Now, we talked about China and US treasuries and the possible response of other foreigners and all the rest of it. I mean, it is absolutely clear to me that the dynamics of the situation are leading to higher bond yields. already the relationship between bond yields at the long end and the S&P 500 is more stretched, if you like, to the disadvantage of the S&P than it has been in recorded history. I mean, we don't have the statistics, but I would say that this market is even more credit-driven than the market in the late 1920s, when you had the Roaring Twenties. You had that burst of credit applied to the stock market in between really about 1926 and 28, 29. And then, of course, you had the Wall Street crash. So we have a setup which looks even worse than that. Now, the point is that when these bond yields start rising above the 5% level at the long end, I think the S&P, the Dow, NASDAQ will be toast. So will ephemera like cryptocurrencies.
Do you think they're going to institute yield curve control in some form or fashion, and that would nominally spare the market?
No. I mean, they can't do it, is the short answer. I mean, yield curve control works under a gold standard, because what you can do under those, and also, I mean, the point about a gold standard is that government deficits are never as great as they are today. They can't be, so there is a discipline, and that's the whole point of it. There is a discipline on governments. While that discipline is in place, you can say, let us say you can sell the short end and buy the long end, and the Fed would do something like that to try and depress yields at the longer end, knowing that it can fund the short end without driving up the rate so much. So you can control the yield curve that way. Can't do it now. You really can't. And the problem is that the only real funding that Besant can do is really out of the T-bill market. That's relatively easy because you've got money funds, you've got bank liquidity and all the rest of it. But when it comes to actually selling the real stuff, sort of 10 years and plus, that's difficult. I mean, even some of the shorter maturities, I think from time to time, the auctions have been disappointing. So that, I'm afraid, is going to happen. I think that we're going to see far higher yields. And bear in mind also the inflation argument that we were just touching on. The fall in the purchasing power of the dollar is going to lead to far higher prices over the course of 2026. Under those circumstances, what's the yield on the long end of the curve going to be? It is going to reflect a far higher level of inflation than the current situation.